Hi, good morning. It's Ty Smith at Manulife Securities. Alongside me is my partner, Marc Hamel, and this is the Friday 5 with Hamel Wealth Management. Joining us today is Mike Greenberg of Franklin Templeton Investments. Mike is VP and Portfolio Manager and also heads up Franklin Templeton's Multi-Asset Solutions, which is a core holding across our client portfolios. Mike, thank you so much for sharing a few minutes with us today. Let's jump right into it. We certainly seem to be living in unprecedented times. This seems to be the go-to description for what the world has experienced this year. But perhaps a good starting point for our clients would be your initial thoughts on the recent downturn and just walking us through exactly how we ended up where we are today.
Thanks again for having me here today. And, definitely unprecedented is a great word on a few fronts, right? Like this is one of the first planned recessions that I know of, in the sense that the governments from various countries basically shut down their economies to prevent the spread of the virus. So obviously the economic hit is massive, and you're seeing that to start to trickle in with the economic data, unemployment, things like that, which are really at historic levels. So from the economic side, absolutely unprecedented as far as the speed and veracity of the hit. But I'd say on the other side of that too is the response by central banks and the response by governments has also been extreme. When you look at 2008, 2009, the policy response that we saw from central banks like the Fed, the Bank of Canada, cutting interest rates, buying back bonds, quantitative easing programs, we've already eclipsed that in a couple of weeks in this one. So obviously huge response there. From a fiscal side, we'll see what the long-term consequences of all this is, but the spending from governments to try to get people over the hump while businesses are shut down has also been pretty unprecedented. So in a way, there's sort of balance. It's a bit of a balancing act between the negative economic effects and the probably more positive policy responses. And of course, it's a very tightrope to try to walk. But those are some of the balances that we're thinking about how that might affect the economy going forward.
Now, Michael, the potential portfolios were already tilted to be a bit conservative because we were so late in the economic expansion. Mm-hmm. How have the portfolios held up, and what are you doing inside the portfolios to either preserve downside risk or provide exposure to an eventual correction?
Yeah, I guess we look at the returns on two fronts. One is just the absolute returns, of course, have been challenged. And when you look at kind of the peak drawdown period, 60-40 bounce type portfolios were down in the high teens. Of course, then we saw a recovery where we were up about 15% or 10 to 15% after that. So it's been a pretty violent fall and then a pretty violent recovery. So the absolute returns have been volatile and, of course, more negative than we've seen in a number of years. But again, like we saw in 2008, 2009, typically the recovery tends to be pretty strong in these types of portfolios as well. So obviously it pays to sort of stay the course. Now, luckily, we had no idea that the COVID was going to hit. But as you say, we were a little bit more defensively positioned in the portfolios going into this, a little bit less equity, and definitely a little bit more conservative on our fixed income allocations. Not as much credit, especially not as much riskier credit than a lot of our peers and competitors. So relative to a lot of our competitors, we've actually held in very, very well in this kind of turbulent period. That being said, we are seeing some opportunities to start to slowly add back risk into the portfolio. So at the kind of crux of the drawdown, we were selling some government bonds to buy back some equity and to buy back some higher quality credit. Of course, the market has run up a lot since then. We're sort of taking our time at chipping away at adding back to risk. So we're kind of not at full positions yet. We're not fully risk on by any means at this point. But within our targets, we're probably about a third of the way there, looking for periods of drawdown in the future to sort of add a little bit more risk. So at the margin, I'd say we're getting a little bit more conservative as we look out positive as we look out 12 to 18 months. But we don't feel like there's a big rush to get there because we do think there's going to be some volatility. And we also don't think the economic recovery is going to be a V-shaped recovery. It's probably going to be a little bit of a slower recovery kind of coming out of the closing of the economy.
Ty and I and all of our clients really appreciate you taking the time to join us today and share your thoughts and help them navigate these unusual markets. Mm-hmm. And for you, we want to say stay well, stay safe, stay healthy, you and your family. And to all of our listeners as well, our clients, we want to say stay safe, stay healthy, and we'll see you soon.
All right. Thanks very much. Have a great day.
Thanks again, Mike. Really appreciate the time.
All right. Take care.